All right, let's talk about something that the absolute best investors in the world obsess over. We're going to pull back the curtain on what might be the single most important number for figuring out if a company is truly a great business. This metric, well, it doesn't lie.
So let me just throw this out there. You see a company, and its revenues are exploding, earnings are going up. I mean, that's a slam dunk investment, right? A no-brainer. But is it really that simple?
Not even close. In fact, those headline numbers, revenue, earnings per share, they can be super misleading because they show you that a company is getting bigger, but they tell you absolutely nothing about how much it costs to get that big. A company can literally grow itself right into bankruptcy, and today, we're going to learn how to tell the difference.
Okay, so here's the game plan. We're going to start by looking at this thing called the growth trap. Then we'll introduce our hero metric, ROIC, or return on invested capital. We'll see how it passes the ultimate test, look at why the pros swear by it, and then finally how to use it in the real world.
So let's start with the problem, the growth trap. This is what happens when a company gets obsessed with getting bigger for the sake of being bigger. They pour tons of money, capital, into new projects or acquisitions that just don't earn a good enough return. Yeah, their revenue might go up, but they're actually making their investors poor with every single dollar they spend.
So if that's the trap, what's the escape hatch? Well, it's this number, return on invested capital, or ROIC. It just cuts through all the BS. It answers one single, incredibly powerful question. For every dollar that's been put into this business, whether it's from stockholders or from the bank, how much actual profit is the management team squeezing out? It's the truest measure of a manager's skill.
Okay, so how do we actually calculate this thing? You'll see the formula isn't that scary. Its real power comes from what it measures and what it ignores. So let's just break it down into its two main parts.
You know, it really just boils down to a three-step process. First, we figure out the real, honest-to-goodness operating profit the company makes. We call that NOPAT. Second, we have to figure out the total amount of money that's been sunk into the business to create those profits. That's the invested capital. And then, it's just simple division. Profit divided by capital. That's your return.
So let's look at that top number, the profit, NOPAT. Think of this as the purest profit number you can get. We look at the company's operating profit and adjust for taxes, but we do it before we account for interest payments on debt. And why is that so important? Well, it lets you compare two businesses on a level playing field, regardless of how much debt one has versus the other. You get a pure look at how good they are at their actual business.
And the bottom number, the denominator, that's just all the money. It's the total pile of cash that management has at its disposal. That includes all the money shareholders put in, plus all the money the company has borrowed. It's the entire capital base that the CEO and their team are responsible for turning into a profit.
Now here's the thing. Getting a company's ROIC number is great, but that number by itself is kind of useless. It's like knowing a car's top speed without knowing the speed limit. To see if a company is actually creating wealth, we have to compare its return against its cost of capital. This is where the rubber really meets the road.
And this is the ultimate test. It's beautiful in its simplicity. We take the ROIC and we compare it to something called the WACC, the weighted average cost of capital. The WACC is just the blended minimum return that all of the company's investors, lenders, and shareholders expect to earn. So if the ROIC is higher than the WACC, boom, value is being created. If it's lower, value is being destroyed. It is really that simple.
Okay, now this is where it gets really juicy, seeing it with real companies. Just look at Airbnb, a massive ROIC of over 35%, absolutely crushing its cost of capital. That's a value creation machine. But then, look at Amazon during this exact same period. For all its incredible growth, its ROIC was actually a little below its cost of capital. So technically, it was destroying a tiny bit of value with its investments. Isn't that fascinating?
And listen, this isn't some obscure academic concept. We're talking about the absolute bedrock philosophy for the biggest names in investing. For these gurus, ROIC isn't just another metric on a screen. It's their North Star. It's what points them toward true quality.
I mean, take Warren Buffett. For him, a high and, just as importantly, a durable return on capital is the defining feature of a wonderful business. And why does he love it so much? Because it creates what he calls a compounding machine. A business that can keep reinvesting its profits at a high rate of return just creates an unstoppable force of wealth creation over time.
His partner, the legendary Charlie Munger, put it even more bluntly. He basically said, forget all the stock market noise. Over the long run, your return as an investor cannot escape the gravitational pull of the company's underlying return on capital. If the business earns 6%, you're going to get 6%. It's an anchor.
And that single idea totally changed investing. And it's not just them. Look at famed investor Joel Greenblatt. He created his magic formula, which had these incredible backtested results. And what was it built on? Well, the very first step was to find good companies. And his definition of good? You guessed it, a high return on invested capital. Quality first, then look for a cheap price.
So we know why ROIC is so important. Now we have to talk about how to actually use it. And the number one rule is this: you can't just look for the company with the highest number. A good ROIC isn't a universal number. It's like asking, what's a good score? Well, it depends if you're playing basketball or golf, right? Context is everything.
And this chart shows you exactly why. A software company doesn't need to build a bunch of factories, so it can naturally get a really high ROIC, maybe 18%. On the other hand, a big utility company has to spend billions on power plants and infrastructure. For them, an ROIC of 7% might be absolutely fantastic performance. You've got to compare companies to their direct competitors.
But you've got to be a little cynical here, because companies can play games. They might take a giant asset write-down, basically saying an old factory is worthless. Why? It shrinks the invested capital on their books, which artificially makes all their future profits look way better by comparison. But here's the big one, the real red flag. Look at the trend. A company might have a great ROIC today based on past investments, but if the return on the new money they're investing is going down, that's a huge warning sign that their competitive edge is starting to fade.
And this is why so many people call it the king of metrics. It's not just some random number. It's like a Swiss Army knife for analyzing a business. It tells you about quality, efficiency, growth potential, and management skill, all wrapped up in one elegant ratio. It forces you to think less like a gambler on a stock ticker and more like an owner of a business.
So there you have it. You now have the lens that the best in the world use to separate the truly amazing businesses from the ones that just look good on the surface. So the next time you look at a company you're interested in, don't just ask, is it growing? Ask, how profitable is that growth? What hidden story is ROIC telling you?